when you do a covered call, the point of doing the covered call is it's a bullish trade. You don't really want to make money on the call. You would rather make the money on the stock going up. Now the stock is going down since I bought it. So the money that I made on the call, I lost on the stock. I'd rather the stock go up. Now, with that being said, so if I'll show you how on the TastyTrade platform, how you would do that. You could come up here. Now you could also anywhere you see bid ask on here, you can buy shares on this platform. So you could hit the bid, you could hit up here. If you want to buy, you get to ask. See it pops up and then put it on 100 shares. And you're gonna see they're gonna margin you the $1,776 on this trade. Now that more than likely they're doing that on this um, because of how volatile the stock is. I would imagine on another on Apple, they may not margin you the whole thing. So you buy 100 shares here, and then you will find the call that you want to sell. You could come on here and now the one that I sold at the time was the 30. I probably wouldn't do that right now because I can see that the market has moved a little bit and the value of this has went down. So more than likely, if I was doing it currently, I would come right around, right outside the expected move, maybe, and or right at the expected move, maybe sell this 39 delta right here. Lock that in. Now you can see you're selling. You'll be taking in approximately, let's say the mid price about 210. Let's just call it $200, just to make it easy. And you see how the value of the buying power went down because you're selling this call. Now, if I take this off and delete this, you'll see buying power is 1776 because that's what the price of the stock is trading at right now. And then you sell the call, lock it in. And that's basically what I did. I just sold the 30. Now, that right there, now if the stock runs up to 30, I just hold the call and let the stock blow through it. And what'll happen is I'd get the stock called away, but I get the price appreciation of from 19 bucks or wherever I bought it at up to 30, which would be about, let's say let's ballpark it'd be about $1,000. Um, because it was like 19 and some change, minus the call that I sold. So then you'd have that, and then that would be the profit that I would make on it. Now, if the stock just doesn't make it up to this range and it just messes around and goes back and forth and retreats a little bit, backs off, and the value of this call just goes down, what I'll do once we get to right here at 21 days, which will be right before the earnings, I'll close that call. That call more than likely will have depreciated in value if it hasn't, depending on the movement of the stock. Either way, I'll be closing that call out, and then I'll be putting another one on or rolling that call out further in time and taking the profit. So that's the benefit of doing a cover call. Another way, something else I could have done is I could have sold a put. Now I could have came right here and maybe sold the 16, sold a put right here at 16 bucks. And you can see this has even lower buying power effect because if you sell this put for 258, now this is a bullish trade. So if the stock continues to go up, I keep the credit, and I still would manage this as well at 21 days and take whatever's left of the call. Sold it, so I'd buy it back for cheaper than what I collected and keep the remaining credit. So if I sold it right here, showing 258, I collect this, and then once the it gets to about 21 days, and then I would, which is, that's another 21 days from now, 3 weeks, then buy it back. It should be at a cheaper. So let's look at. I'll show you guys what I'm talking about right now. The 16 the 16 put. Excuse me. Collect. I will collect 258. Now let's check this out. Clear that out. Let's go to 21 days. You see the 16. put right here at 174. Yeah, so mid price probably right now is, man, maybe about $2. So those 3 weeks, which I think this is elevated because of the short term volatility right now, but more than likely this will be like probably about 158, something like that. And that means I'd make $100. Some th- that's those are the ways, if that's if you're bullish. Now some people may say, hey, I don't want to take the other side. There's no way I short this though outright. Just me looking at this technically, there's no way I short this. I wouldn't short this with somebody else's money. Just because looking at the option chain, like I go out 42 days and look at this option chain. When I looked at it earlier this morning, this expected move was way out here. But look at the delta, to you can't even sell a 16 delta out here. So you got a lot of skew um in this so basically, let's go down to the expected move down here. Right? This is what I mean by skew in the option chain. If you come right here and look, so from here to here is the same distance. It's $7.17 from the price to the bottom side to the top. I know it looks backwards being on the, but that's how the option chain is. Now I could click it and flip it around, but this is the original way how the option chains look. All right. Even though this is down, this is up on the chart or on the stop, and vice versa. So from here, where current price action is, this is $7 here and $7 here. Look at the delta down here at 11. That's a 10 delta, and you're only collecting $57 right here. Now, if you go $7 up, look, this is a 39 delta, and you're collecting $200 right here. There is no way I would step in front of this. Meaning you'd have to sell like 3 or 4 of these to equal one of these calls. That's skew in the options. That's what you call skew. And I keep a track of that on over here on my watch list. I got skew. Now this is measuring different skew, but I have a certain number that I look for when I think that the market is getting to bearish, or where I should be looking to short something, right? Now over here, when you see that, now let's go look at something like the SPY, and I'll show you the difference in the skew. We're gonna go 42 days. Hey, if you watching this after the live stream, or you watching this further out in time, hit the like button. There's nobody online for the most part that's talking to you this in depth about options for free. Let's get back to it. Now we're gonna go same thing over here. We have a $16.50 expected move. Let's go down to the extent to the bottom of the expected move. You see where it says 22 delta, right? You collect 290. Let's go over here. At the end of the expected move, look, you got a 22 delta, right? 22 delta here, 22 delta here. So that's telling you basically th- uh you almost got a what I would say a more balanced option chain. It's not skewed in either direction for the most part. You collect a little bit more on the call side, excuse me, on the put side than you do the call side, just a little bit more, but not a whole lot. To me, what that's showing me when I look at GameStop, let's go back to GameStop. To me, that's showing me these calls are worth more because you're taking more risk. I can look at the option chain and tell you where the risk is. You ain't getting that much money for selling these. You don't collect a whole lot of money for selling these calls, or excuse me, selling these puts, or buying these puts. You could buy these puts. Let's say you want to short. You say, I'm gonna short it for whatever reason. You're gonna buy it. It's cheap. $7 to the downside is cheap. If you say, "Oh, I'm gonna buy the call, $7 to the upside," costs a lot more, right? It costs more because there's more value in these. There's no value here. It's very little value down here because it's very little risk, in my opinion. The market is telling you the risk is over here to the upside. So with me seeing I'm like, I would not short. I'm not going to short something where the market is telling, unless you want to take the risk, and it's the market is going to pay you for taking this risk. The risk equals the reward. You get more reward here for selling these options, but there's more risk as well. And the option chain is telling me that.